The global landscape changed dramatically with the onset of the COVID-19 pandemic in spring 2020, leading to economic turbulence nationwide. By 2022, inflation surged to a 40-year high, prompting the Federal Reserve to take action by raising its target rate in an effort to curb rising prices. This move affected borrowing costs for Americans, but also presented opportunities for savers. As we approach a presidential election, understanding the relationship between the president and interest rate decisions becomes crucial. Let's delve into how the Federal Reserve influences interest rates, the role of the president, and strategies to optimize your savings amidst fluctuating rates. Explaining the Federal Reserve's influence. The Federal Reserve, through the Federal Open Market Committee, FOMC, dictates the federal funds rate, which influences short-term borrowing costs among financial institutions. When the FOMC adjusts its target rate, banks tend to follow suit. Higher rates make borrowing expensive but offer increased returns for savers, while lower rates stimulate borrowing but decrease returns on savings accounts. The recent pause in rate hikes, maintaining the target rate at 5.25%, 5.50%, reflects the Fed's focus on achieving a sustainable inflation rate of 2%. Does the president control the Fed? U.S. presidents don't have authority over the Fed, but they do have certain powers that can impact the future of the Fed and its decisions. The president can appoint and fire the Federal Reserve Chair. The chair of the Board of Governors of the Federal Reserve System leads the Fed in working toward its key goals, including maximum employment, stable prices, and moderate long-term interest rates. Some of the Fed chair's responsibilities include reporting to Congress on the Fed's monetary policy objectives, testifying before Congress, and meeting periodically with Treasury Secretary Janet Yellen. According to the Federal Reserve Act, the chair and vice chair of the board are appointed by the president but must be confirmed by the Senate. Fed chairs and vice chairs serve four-year terms and can be reappointed by the sitting president. They can also be ousted by a sitting president, although this has never happened. The president can nominate key officials. The president also nominates the 7 members of the Board of Governors who serve on the FOMC and oversee the 12 reserve banks. Each member is appointed for up to 14 years, which is considered a full term, after which they can't be reappointed. Other than nominations, the president has zero impact on Federal Reserve interest rate policy, said Scott Fulford, a senior economist at the Consumer Financial Protection Bureau. The president can discuss monetary policy and voice concerns. Though presidents can't control interest rates directly, they can discuss their stance on current monetary policy and its impact on rates. But this can be a touchy topic. Institutionally, the Federal Reserve is very protective of its independence because that independence helps it achieve its mandate, Fulford said. Most presidential administrations go out of their way to avoid even publicly commenting on Fed policy. Preparing for interest rate fluctuations. Given the uncertainty surrounding interest rates, implementing savvy savings strategies becomes paramount. High-yield savings accounts offer competitive rates compared to traditional options, providing stability amidst fluctuations. Leveraging compound interest by initiating savings early allows for exponential growth over time, irrespective of rate changes. Regularly reviewing savings account options ensures optimal returns, while locking in rates through certificates of deposit, CDs, offers stability, albeit with the caveat of early withdrawal penalties. Navigating the intricacies of interest rates necessitates understanding the Federal Reserve's role, the president's influence, and prudent saving strategies. While interest rate fluctuations may seem daunting, proactive measures, such as utilizing high-yield accounts and locking in rates through CDs, empower individuals to weather economic uncertainties and maximize savings growth. As we look towards the future, staying informed and adaptable remains key to financial resilience. Thank you for watching. Don't forget to like and subscribe for more insightful content.